Hello, welcome to this video. Before we get started, I just wanted to post up this disclaimer to tell you that trading is risky. So don't risk money you can't afford to lose, don't listen to me. This is just for your entertainment. The reason I've taken so long to post this video is because I've actually been trying to compile some numbers, and this is what it looks like. It's basically showing the $1,950 starting at February 10th, and it's basically following the actual trades that close out. So you can see that the trades that we had on, primarily those four that I mentioned in the last video, the Euro, Sugar, UST Bond, and Copper, they essentially all were in play until they started to close out, and as you can see, they closed out at losses. Now we'll go through each trade itself, and you'll see how it kind of works. But I think this is somewhat a good example of what to generally expect, because you see that we have a small loss, we have a small loss, we have more losses, and we get down to a value of 1850 or just under 1850, and then one trade, which would have been the T-bond trade, I believe, closed out and brought us back up. So at this point in the 10 weeks, we've closed out with a $79.74 profit for a 4.1% return. So I mean, that's actually quite good, considering I haven't done that much in terms of analysis and having to really follow things. Now again, I don't know if I'm doing it 100% correct. I took these four different markets which seem uncorrelated and basically applied the breakout entries, the unit sizing, and this is what's happened so far. Now that being said, there are still trades that are currently on. So if we go to the chart, I'm going to show you what we still have on. So the copper trade, the XCU, is still on. It currently has a profit of $164. So that would potentially add to what we have now, but of course, as I said before, that profit is not guaranteed. At this point, the stop loss itself has trailed up. Here's our total entry, because we have, I believe this one has 3 units, and this is the 20-day range. So as it moved past the entry, the stop started to trail up, and so you can see here around April 5th that it actually got kind of close to the level that would have stopped out the trade, but it continued to go up and is now currently close to the previous highs. So that trade is still open. You also see that there is a German bond or something, so it's kind of interesting that I'm essentially taking trades without actually knowing what it is that I'm actually trading. So this particular trade, I entered on this breakout here. So you can see right here at this level, I got in here, and that seemed like pretty much the low of that day. It turned around and now is sitting higher. Stop loss is up here, so we're kind of halfway between the entry and the stop. So we'll see what happens. And as you can see, I have the, sorry, let me just move this. I have the 3 additional sell stops in place. This is obviously because we've broken to the downside. This blue line, if you can see it, this blue channel here is the 55-day channel. You can see it marked off here, the 55, and the green is the 20. So just as a recap, when it breaks to the lower side, then it's a short. When it breaks the 55 to the upper side, it's a long, and a 2 ATR stop is set, which is this level that's currently in. And when, for the short purposes, when the 20-day range surpasses that stop, then we trail it to allow it to follow the market. So you'll see it more when we look at the trades that have closed out, because as you can see, the 4 trades we had on, the only thing left right now is the copper. So let's go back to the spreadsheet and we'll look at each trade itself. So I'll start with, I think sugar was one of the first trades. If we just highlight here, you can see that it closed out ultimately with a loss of 39.66. We entered, so I don't know, maybe we should write that down somewhere. Sugar closed out at 39.66. So this just basically shows the orders that were entered. Actually, no, this one was actually 2 sets of trades, which was interesting. Initially it was a buy. Let me bring up the chart. If we look at February 11th, let's bring up sugar. So February 11th, and around here, here's the breakout to the upside. We got in, took the trade, and then again the initial stop loss would have been somewhere here, and eventually the market went up, came back down, and at the same time you start to see the trailing stop is coming closer and closer, and we probably got taken out right around here, March 17th. Let's just go check. Yeah, March 18th, we see that we are closed out. So we closed out with a loss of $13 there. Now what was interesting is now we see on March 29th it broke to the downside. So again, you're supposed to take the trades, so I thought, hey, if it didn't go to the upside, it probably will go to the downside, and that did not pan out. We see here that closed out at a $26 loss. So again, it's about the same trading size as almost the same trading size as it was to the upside, and so that one basically closed out at a loss in both directions. Next we have natural gas, and natural gas we got in at the same date, and then this is I think when I was first trying to get a hang of things, and I did not put all of the stop orders in. As you can see with the Bund, I put all the stop orders in at the same time now, so that I basically don't have to follow it. I mean, it's probably not the best way to trade. I'm guessing if you're a pro, you're going to be following the market and you can execute the trades, but I don't follow it all the time, so I kind of just leave it and trust that the stop orders are going to work. Yes, there's probably going to be some slippage and so forth, but I think the fact that because this mainly trades a longer term trend and the sizing accounts for that, that whatever slippage and discrepancies there are will be kind of averaged out. It would be a bit different if it was a short-term trading system where I think every penny counts, but again, we'll see. So that's just really why I leave these in now, because what happened before, as you can see with this trade, I think so with the natural gas, I think what happened is it probably triggered, and then so something like here probably triggered, and then I just figured I'd watch it, but by the time I saw it again it was probably much higher. And so anyways, this one did have a decent run up and it actually looked quite good, but it promptly turned around and once again hit the stop loss. Actually, this one did not hit the stop loss. This one I closed it out early. Because after this run up and it just seemed like things were not going to go, I closed it out. So that was the first instance of not following the rules. So let's look at the euro. I figure I'm going to look at the euro first because it actually is part of the losses that happened earlier on. And so that's why you see back in the chart, initially we had the equity trading down and then a spike. So this is because of the losses that occurred early on. And I guess if you look at it, it's the fact that the losses tend to close out fairly quickly. If the trade isn't going to work out, it tends to trigger. So for example, it tends to trigger and then it if it doesn't work out, it closes out at a loss, and we're kind of done. And so I think these tend to just accumulate as we've seen. And so for the euro itself, that's what happened. Where I just showed you on the chart, we got in, and I guess in what, a 2 week, I guess it's even a bit longer than that, maybe about a 1 month period, it got in and closed out at a $37 loss. So I can mark that down. And so this is now where things get counterbalanced, because we have the US T-bond, and this trade was started in February, same day as the sugar, and it didn't close out till about last week. And if we look at that chart, then you see that we entered somewhere around here. It moved up. It didn't get close to the initial stop loss, so we entered around here somewhere, actually more the 10th, so a little bit later here. I would have been in early here, but I didn't actually start looking at stuff till this date. So even despite that, I think I might have entered somewhere here. Anyway, I could look at the chart, but the entry was somewhere here. We didn't get close to the stop, and then the market continued down. So this is a good example of how the trailing stop works, because it really gave space for this trade to run. And I think this is really the design of this strategy, that you're looking for trades kind of like this. I mean, I'm assuming that you're looking for bigger runs than this one expected, but this is a good example of how the market made its move. And again, on this date, the market's down here, and the trailing stop is way up here. So it's still trying to give the trade room to move. And so now we're in the end of March. The market is kind of slowing up here, and trailing stop has now really tightened itself up, and we got stopped out probably around here. Let's see, maybe April 14th. So we go back to the chart. Yeah, April 15th we got closed out, and that closed out for a profit of 191.90. So you can see that it's a larger gain in that case. That helps to offset the earlier losses. And then we've got copper, and copper is a trade that is still currently on. So here's where it is. Again, this one is a little bit, because I didn't start trading until, what was this date? Somewhere around here. So the same time, around February 10th, 10th and 11th. And this trade also, started to make its move. Looks like it was, going to the moon, and then it promptly turned around. So again, it didn't challenge the initial stop, and you see that slowly the trailing stop surpasses the entry, and now it just follows the market up. And so it looked around this date here, the April 5th date, it looked like it was very close to getting stopped out, but somehow it did not, and it's now close to its previous highs. So it's been very interesting to experience this, because you get a real feel for how the trades shape up, and how it kind of just gives it a chance to go. Now, the challenging part is watching, the moves up to here, and you kind of can get excited thinking, wow, maybe this thing is going to go, only to watch it turn around and stop out for, hopefully a small gain. You can see that the bond stopped out for a fairly okay sized profit in relation to its initial risk. But it really, what counts is the fact that it needs to offset these losses. So that's really what's been going on for the past 2.5 months. So if you take the current closed off profits, we're at 2035, and we still have about 158 right now in an open trade. Hope you found this interesting.